Myles, welcome to Bottom Line. Thanks so much for joining us today.
My pleasure.
Myles, 12 of the 18 manufacturing industries tracked by the ISM reported growth in September, and they include food and beverages, clothing, autos, and chemicals. Even with that rebound, the markets are showing weakness on this first trading day of the last quarter. Why don't investors seem impressed with today's numbers?
You know, today seems to be a bit of a litmus test for psychology out there. And what the economics reporter said is right, that the ISM came in a little better than expected. One of the concerns, obviously, was the new orders component. It's down 3 months in a row. But I think more importantly, you know, we've all become global equity strategists these days. And if you looked at the same or the cousins of the ISM that were reported around the world today, they weren't as enlightening as the ISM itself. If you look particularly in Europe, most of those manufacturing PMIs were down and down pretty significantly. So it's telling you that the financial strains in Europe are definitely biting. And in some important key regions around the world, we saw some weakness as well, like in Brazil, Taiwan, India, and China. So I think what we're all concerned about here is you know, the epicenter of the problem today is not really, I'm not saying we don't have our problems, but the epicenter of the financial strains are not really domestic made this time around. So I think that's what the global people are focused on.
Well, Myles, those ISM numbers, show that the economy is growing, but too slowly for Americans who are suffering. That said, do the numbers indicate the economy is not headed for another recession?
Well, the numbers tell us that we're very vulnerable in the sense that a 51.6 reading on the ISM is only marginally above boom bust. So any external shocks could quite easily tip us into a negative growth profile. And I think this is what we're seeing in the markets today, is the worry that we are vulnerable, we have a fragile recovery, and any external shocks could definitely send earnings into a downturn.
And those external shocks at this point, the eye is towards Europe?
I think most of the eyes are towards Europe. Obviously, we've had some reports about some financial strains that are developing in China. Obviously, the equity markets over there are behaving as something perhaps negative is going on. But yes, indeed. I think, you know, there's two problems coming out of Europe right now. One is the message. There's no clarity in the message coming out of European policymakers. We hear one thing one day and something the next. And I think the execution has been something to be desired as well. So I think we need some forceful policy, you know, to address these situations in Europe and to give people some confidence in the outlook.
Manufacturing, it accounts for a small percentage of the overall U.S. economy, about 11%. But that sector continues to shoulder the broader recovery. What happens to equities if new orders don't pick up significantly?
Well, I think for sure in some of the more cyclical segments of the equity market, like the industrials and the materials sectors that are highly levered to the manufacturing sector, I think they continue to lag the market if we don't get a pickup soon. You know, broadly speaking, though, the concern is that the manufacturing sector is something like a canary in a coal mine. So we are very concerned that that this could sort of broaden out and put, you know, more widespread earnings pressure on the market.
And finally, equities. Are they underpriced? Bloomberg data shows analysts are cutting projections for profit next year by about 2.6% to $110.78 per share.
Yeah, I mean, the estimates are coming down now, and I guess, you know, if you could take those estimates at face value, the market would look very attractively priced. I think the concern that investors have right now is that even at, you know, $110, that's way too high still. And, you know, if we do enter some sort of very slow growth environment or even slower, perhaps recession, as some people are talking about, that could easily be an $80 handle, and obviously then the equity market doesn't look as cheap. So I think what we need to see is some sort of confidence that there's stabilization in the outlook, and then we can start to reprice the equities accordingly. Right now, we're all going in one direction, taking our growth estimates lower.
Myles, if I might ask you in 15 seconds, expecting anything from Chairman Bernanke when he testifies before that Joint Economic Committee tomorrow?
No, I mean, he's obviously going. I think he's going to obviously say that that they are stimulating the economy, they are doing what they can do, but they can't do it alone.
All right, Myles, thanks so much today.